सो दिस पर्टिकुलर वीडियो सीरीज़ ये बहुत काम की है। इसमें सबसे इंपॉर्टेंट सम्स है CA फाइनल AFM के लिए, जिनका आने का चांसेस बहुत हाई है। और सबसे बेस्ट पार्ट ये है कि इसमें मैंने टाइम ज़्यादा स्पेंड नहीं किया है, टू द पॉइंट डिस्कशन किया है, सम्स दिखाया है, आगे बढ़ा है। और इसके साथ PDF जो है वो इस डिस्क्रिप्शन में दिया हुआ है। इनफैक्ट आपके लिए बेस्ट क्या होगा, आप PDF का क्वेश्चंस पहले ट्राई कर लीजिए, और अगर किसी क्वेश्चन में अटेम्प्ट करते हैं तो केवल वो वाला पार्ट देखिए। तो उस केस में क्या होगा कि आपको हो सकता है ये जैसे 50 मिनट्स का वीडियो है सपोज, तो आपको केवल 5 मिनट में पूरा फायदा हो जा रहा है 10 क्वेश्चंस का। एंड यू नो CA फाइनल AFM इज ऑल अबाउट सम्स। तो 2-5 मिनट में यू आर एबल टू कवर 10 सम्स स्ट्रेट अवे। डोंट इग्नोर दिस, वेरी वेरी इंपॉर्टेंट फॉर यू टू पास।
Question number 39 is also on currency of investment. Question number 39. A foreign institutional investor FII is planning to invest $10 million in an Indian security with a beta of 1.4. Okay, so US FII investing in India, a stock which has a beta of 1.4, aggressive stock, and a standard deviation of 10%. That's the SD of the security. If we were doing portfolio management, SD tends to measure total risk, the systematic and unsystematic both, while beta captures the systematic risk. It has nothing to do with this sum. I'm just trying to tell you. Holding period of investment will be 1 year, 1 year time horizon. Current rupee dollar exchange rate is rupees 48 per dollar. So initially $10 million will be converted into rupee. Initially $10 million will be converted into rupee. So 10 into 48 is 480 million rupees. Okay, there is no bid ask in this sum. 10 into 48, 480 million rupees. FII expects the rupee to depreciate against dollar by 4% over the next 1 year period. So rupee will depreciate by 4%, but the base currency is dollar. According to all past solution of ICAI, they do the adjustment based on the base currency. Rupee will fall by 4%, that means dollar will rise by 4%. Rupee will fall by 4%, that means dollar will rise by 4%. So they do it as 48 into 1.04, which is mathematically wrong, because if rupee falls by 4%, dollar will rise by more than 4. We should do 48 by 0.96, but ICAI does it as per the base currency. The base currency is dollar, so rupee falling by 4%, that means dollar rising by 4% approx. So they do it 48 into 1.04. Do not hurl questions at me, sir, this is wrong. I am saying this is wrong, but this is how ICAI does it. So what if ICAI does it correctly, 48 by 0.96 is the next paper? Then what do I do? You have to give a note based on the solutions presented by ICAI up till now. They do the solution wrong when they say the numerator currency is going to fall by 4%. That means the denominator is going to rise by 4%. So 48 into 1.04. I've explained what I wanted to explain. The extra hoshiyar people can keep on writing. There is no issue. 48 into 1.04. So 48 into 1.04 is the exchange rate after 1 year, which is 49.92. 48 into 1.04. I think it's coming to 49.92. Check it out, please. 48 into 1.04. Is it 49.92? Yes, 48 into 1.04 is 49.92, the exchange rate after 1 year. FII expects rupee to depreciate, okay, that's okay, with a volatility of 8%, that's the volatility of exchange rate. So when you invest abroad, you are suffering not the volatility of the stock, but also the volatility of currency. When a US person invests in India, he is going to be affected by the risk of the stock as well as the risk of the currency. The risk of the stock was 10%, risk of the currency is 8%. Expected return from the market portfolio RM is 12%, and the standard deviation of return on the market portfolio is 9%. That is sigma M. Correlation coefficient between the return on security and the exchange rate is 0.15. That's correlation between the stock and exchange rate. Risk-free rate of return in India is 6%. You are required to calculate the expected return and risk for the FII. So, first of all, we are talking about calculation of expected return. To calculate the expected return, we have to go step 1. $10 million is sold at 48 to get rupees 480 million. $10 million is sold at 48 to get rupees 480 million. Now this is invested in India in a security with a beta of 1.4. So expected return in rupee terms is equal to RF plus MRP into beta. So RF was 6%. MRP is RM minus RF. I think RM was 12. Yes, so 12 minus 6 is 6. Market risk premium is 6. Into beta is 1.4. So what is the return as per CAPM? What is the return as per CAPM? Yes, please. What is the return as per CAPM? It's 14.4%. 14.4% is the return as per CAPM. Step 3. So 480 million into 1.144, 14.4%. 480 into 1.44 becomes what? 480 million at the rate of 1.144 becomes what? So after 1 year, what is the expected rupee inflow? 480 plus 14.4% is 549.12. 549.12 million rupees after 1 year. Now this has to be converted into what? Dollars. So expected spot rate after 1 year is 48 into 1.04. It should have been 48 divided by 0.96. But ICAI does not do it that way. They do it as per the base currency. Rupee falling means dollar rising. So this is, you all said 49.92. This is, you all said 49.92 expected exchange rate. So step 5, the amount which you all said after 1 year, which is 549.12. 549.12 divide by 49.92. What is the dollar inflow after 1 year? 549.12 divide by 49.92. 549.12 divide by 49.92 is equal to $11 million. $11 million. So we started with $10 million and we expected to get $11 million. The return is obviously what? 10%. The expected return is obviously 11 minus 10 upon 10 into 100, which is what? 10%. 10% is the expected return. 10% is the expected return. Whereas the expected return of the stock was 14.4. But here, since rupee is depreciating, therefore it's a dampener. Okay, since rupee is depreciating, it's hurting our returns. So 10%. Now they're asking the risk. Now whenever you invest abroad, the risk of the investment is given by a formula. It's variance of stock plus variance of exchange rate plus 2 into correlation into SD of stock into SD of exchange rate. Variance of stock plus variance of exchange rate plus 2 into correlation into SD of stock into SD of exchange rate. Please check in the above formula. SD of market will not come. We have invested in the stock, we have invested in the currency. So variance of the stock, variance of the currency plus 2 into covariance between them. Why does the weight does not come? Because the weights are 1, 1. 1 square is what? 1. It's actually weight square. But the weight is 100%, 100%. Because the entire money is invested in the stock, the entire money is invested in the currency. So weight vanishes. So the SD of the stock was 10. So 10 square. SD of the exchange rate was 8. I am cross checking. Yes. SD of the market is not relevant. SD of the stock was 10%. SD of the currency was 8%. Correlation is 0.15 plus 2 into 0.15 into 10 into 8, the whole square root. That's the SD of the investments. So this will be a very easy sum for students who must have done the sum once. But this is a non-touchable sum. People can't do the sum, especially the risk part, if they have never been exposed to the sum. So when you prepare for the CA examinations, you should always try to see that if we are doing new variety of sums which have never come, in that case, we just need to know them. You don't need to think you need to solve 50 sums of this type. One awareness. You may feel it's very easy. After knowing it's very easy. If you don't know it, in that case in the exam, it's untouchable, the second part. Okay, whatever the answer is coming. Students have calculated, the answer is coming to 13.71%. Okay, perfect. This is question number 6, convexity, which came in the exam. The following data are available for a bond, face value 10,000, to be redeemed at par on maturity. So coupon rate 8.5%, maturity 5 years, YTM 10%. Since YTM is 10% higher than coupon, if we pull, the bond will trade at a discount. Question number 1, calculate the price of the bond. Okay. Question number 2, calculate Macaulay's duration. So question number 1 and 2 can be done together, because when we are doing Macaulay's duration, when we do the present value, obviously we'll get the price. Question number 3, calculate volatility of the bond. That's modified duration. Question number 4, calculate convexity of the bond. Look, convexity is to be done without the shock given. So we should use that Macaulay formula, plus the table is already prepared. Everybody will use that. But the institute has used P1 plus P2 formula. Question number 5, calculate the expected price if yield falls by 200 basis points. Now this is not a shock, this is a forecast. Okay, that interest rate will fall. So find out the price, number 1 using duration, number 2 using intrinsic value method. And here the annuity factors and all that are given. So let's do it. So I'm doing the solution. Here's cash flow, discounting factor at 10%, present value, this is W. WX, because the first column was what? Years, that is X. And I am preparing one more column, WX into X plus 1. So this becomes the working for all the questions. So years, it was a 5-year bond, I think. Yes, 5-year bond, 8.5% coupon on 10,000. Sorry. So 1, 2, 3, 4 and 5. Cash flow 85. I think it's not 85. 8.5% of 10,000 is 850. So it will be 850 and 10,000 850. Okay, because face value is 10,000. Now discounting factors are given to us. Whenever they are given to us, we have to use what is given. Discounting factor at 10%, 0.909, 0.826, 0.751. I'm copying them. It's boring, but I'm doing it. 0.909, 0.826, 0.909, 0.826, 0.751, 0.683, 0.751, 0.683, and the last discounting factor is 0.621. 0.621. So now we multiply 0.909 into 650. 0.909 into 650 is coming to, sorry, 0.909 into 850. 850 is coming to 772.65. 772.65. I know you are doing faster. I do slow. 0.826 into 850. It's 702.1. 702.1. 0.751 into 850 is 638.35. 0.683 into 850 is 580.55. 0.621 into 10,850 is 6737.85. So I'm adding them up. We need the total. 772.65 plus 702.1 plus 638.35 plus 580.55 plus 6737.85. It's coming to 9431.5. That's the first answer. 9431.5. Okay, the first answer. Price of the bond, market price. 9431.5. Okay, now we need the duration. So WX. 772.65 into 1 is obviously 772.65. Let's also do the last column parallelly. So 772.65 into 2 is what? 772.65 into 2 is 1445.3. 1445.3. Now 702.1 into 2 is 1404.2. And 1404.2 into 3, 1404.2 into 3 is 4212. 4212.6. Are you understanding? I'm multiplying by x plus 1. 638.35 into 3 is 1915.05. 1915.05. And what is 1915.05 into 4? It is 7660.2. 580.55 into 4. It is 23222. Sorry. 580.55 into 4 is 2322.2. 2322.2. And what is 2322.2 into 5? It is 11611. 11611. Last 6737.85 into 5. This is 33689.25. 33689.25. And what is it? This into 6. This is 202,135.5. 202,135.5. So we need a total of these two columns. Okay. So 772.65 plus 1404.2 plus 1915.05 plus 2322.2 plus 33689.25. This total comes to 40103.35. 40103.35. Last column, 1445.3 plus 4212.6 plus 7660.2 plus 11611 plus 202135.5. So this is coming to 22,70646. 22,70646. I hope I am not doing any calculation mistakes. So we asked Macaulay's duration. So Macaulay's duration is summation Wx by summation W. So it is 40103.35 divided by 9431.5. So this comes to 4.25 years. Now we want volatility, bond volatility. That is MD, modified duration. It is duration by 1 plus R. So it is 4.25 divided by 1.1. 4.25 divided by 1.1, the 10% YTM. 4.25 by 1.1 comes to 3.86%. So if interest rate changes by 1%, bond price will change by 3.86%, ignoring convexity in the opposite direction. Convexity, it is summation Wx into x plus 1 divided by summation W 1 plus R whole square. So what was the last column? The last column was 22,70646. So it's there will be a 2 in the denominator. Summation Wx into x plus 1 divided by 2 summation W 1 plus R the whole square. I forgot the figure. It is 22,70646. 22,70646 divided by 2 into summation W. Summation W is 9431.5. 2 into 9431.5 into 1 plus R the whole square. So into 1.1 square. Yes, please. This figure. 22,70646 divided by 2 into 9431.5 into 1.1 square. That comes to 9. So this is coming to, just 1 second, let me check again. So it's coming to 9.948. 9.948. Convexity, rate of change of duration. Okay, convexity. So what has ICI done over here? If we check ICI's answer, the first part, the price of the bond is 9431, we got the same answer. Duration 4.25, we got the same answer. Volatility 3.86, that's okay. Convexity, they have done by this formula. You can see. They have done by the other formula, but the shock was not given. Where is the 2%? The shock was not given. So that they have used from the next question, where the forecast was given. So they applied P1 plus P2 minus 2 P0 divided by 2 P0 delta Y square. Okay, that is convexity. Since if this sum is repeated, you should solve it by this method only. Okay, if this sum is repeated, therefore I am once again computing the convexity as per them. Okay. So alternate solution for convexity. Alternate solution. But sir, you said people got the marks even when they did by your method. They got the marks, but we are not sure. So if the same sum comes, who will take the risk? You better remember and do their solution. So convexity is P1, the lower price, plus P2 minus 2 into P0 divided by 2 P0 delta Y square. Delta Y is the shock. So delta Y is 0.02 because 2% in the next question it's given. So the yield was 10%. This is the current yield. Now negative shock, that is YTM equal to 10 minus 2 equal to 8%. So let's find out the bond price P2. It is 850 into annuity factor 8%, 5 plus 10,000 into discounting factor 8%, 5 equal to, it's 850 into, what's the annuity factor? Let's see. Okay, 8%. Annuity factor, let's add them up. 0.926 plus 0.857 plus 0.794 plus 0.735 plus 0.681. So annuity factor is 3.993 plus 10,000 into, what was the last discounting factor? 0.681. 10,000 into 0.681. So this is the higher price corresponding to a negative shock. 10,204.05. Now we have positive shock. If you'll check your copy, I had done effective duration via this method in class. Positive shock, that is YTM equal to 10 plus 2 equal to 12%. So P1, the lower price, is 850 into annuity factor 12%, 5 plus 10,000 into discounting factor 12%, 5. I am directly writing the answer. Okay, 850 is 5 times, so it's an annuity. 10,000 is the face value. We have to do the present value at 12%. 850 is the annuity. 10,000 is the face value. We have to discount at 12% for 5 years. So we are getting 8738.33. 8738.33, because this time the annuity factor and the discounting factor were not given. So let's apply the formula convexity equal to P1 plus P2 minus 2P0 divided by 2P0 delta YTM square. What is P1? 8738.33. 8738.33, the foreign price, plus P2 is the higher price, which is 10,204.05 plus 10,204.05 minus 2 into P0, 2 into 9431.5 divided by 2P0, 2 into 9431.5 into delta YTM square, 0.02 square. Okay, 8738.33 plus 10,204.05 minus 2 into 9431.5 divided by 2 into 9431.5 into 0.02 square. Okay, so have the institute got the same figures? Just 1 second. What are the prices they got? Yeah, 10,204, 8733. Did I get 8733? 8738. Okay, this is 8738 we got. Okay, they got 8733. They might have used some table because 12% discounting factor was not given. So how do I know what table they will use for the purpose of doing it? I use the Calci figures. So we are getting, once again I'm checking because I'm getting 10 point something. Let me check again. 8738.33 plus 10,204.05 minus 2 into 9431.5 and then in the denominator 2 into 9431.5 into 0.02 square. Don't do a mistake in the denominator. It's 0.02 square into this. It's coming to 10.52. I am getting 10.52. Okay, 10.52. The institute is getting 9.867 because they got 8733 in the numerator corresponding to 12% YTM. Now, how do you match these figures? So maybe by taking the annuity and the discounting factor in 3 decimal places. Let me check whether it's coming. Okay, I'm just checking the annuity factor and the discounting factor. Just 1 second. So I had initially used the full Calci strokes. Now I'm trying to using 3 decimal places over here. I'm coming back to the calculation of P1. Over here P1. So in 3 decimal places, the annuity factor is coming to 3.605 and the discounting factor is coming to 0.567, and if you use that we are getting 8734. Are you understanding? 8734. And if we use 8734 over here, 8734, let's check what are we getting. 8734 plus 10,204.05 minus 2 into 9431.5. Okay, that is the numerator, and now in the denominator 0.02 square into 9431.5 into 2, and then we divide. So what are we getting? We're getting 9.94. Okay, we're getting 9.94. So the crux is that when the discounting factors that are given in the question are in 3 decimal places, so when you are doing calculation for 12% for which discounting factor is not given, you should be using 3 decimal places. Why are you not understanding that actually this sum is not supposed to be solved like this? Because otherwise, why is 12% discounting factor not given? This sum is supposed to be solved by that summation wx into x plus 1. But that's a mistake by the institute. Anyways, fifth part, expected market price if there is a decrease in YTM by 200 basis point by the Macaulay duration method, by the intrinsic value method. By the intrinsic value method means by discounting at 8%, we already got the price 10,204. So the part B answer is 10,204, which I calculated. Okay, and as far as duration is concerned, what was the duration? The modified duration. The modified duration that I got over here was 3.86. So price will go up by 3.86 into 2. Price will go up by 3.86 into 2, 7.72%. So 9431.5. 9431.5 plus 7.72% of 9431.5. 9431.5 plus 7.72%. So that comes to 10,159. 10,159.6 approx. So if you use only duration, the price will rise to 10,159. But if you use the present value intrinsic value method, it's 10,204. Check the answer. Yeah. By duration, it's coming to 10,159. Yeah. And by the intrinsic value method, it was 10,204, correct? Okay. So, they spoiled the sum by doing a wrong calculation for convexity. Multi-period DDM with transition. Let's have a look. The current EPS of B Limited is 4. Company has shown an extraordinary growth of 40% in earnings in the last few years. So we are not concerned with the growth of the past. We are concerned with growth of the future. We know E0 is 4. High growth rate, that is 40%, will continue for the next 5 years. After which growth in earnings will start declining from 40 to 10% during the next 5 years and remain stable at 10% thereafter. Are you understanding? 40 to 10, that is 30% fall in 5 years. Let's see whether the fall is linear. The decline in the growth rate during the 5-year transition will be equal and linear. So if it falls 30% in 5 years, so the fall per year is what? 6%. So what are the growth rates? The growth rates are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And the growth rates are 40%, 40%, 40%, 40%, 40%, then 40 minus 6, 34, minus 6, 28, minus 6, 22, minus 6, 16, and then what, 10. These are the growth rates. And what was the EPS? The EPS was 4. So we can easily grow the EPS now. What is 4 into 1.4? What is 4 into 1.4? It is 5.6. And what is 5.6 into 1.4? It is 7.84. And then I know you can calculate, please. Don't expect me to calculate all the growth rates. When you come to the 6th year, obviously you have to do into 1.34, then into 1.28, into 1.22. So you get the EPS forecast for the 10 years, EPS forecast. Next, we need the payout ratio. Currently, the company's payout ratio is 10%. It is likely to remain the same for the next 5 years. And from the beginning of the 6th year till the end of the 10th year, the payout ratio will linearly increase and stabilize at 50% at the end of 10th year. So 10 to 50 is what? 40% growth in payout ratio in 5 years. So the rate is 8%. So it's 10, 10, 10, 5 times. Payout ratio is 10%, 10%, 10%, 10%, 10%, 5 times. Then 18, then 26, then 32, then 18, 10 plus 8, 18, 18 plus 8, 26, 26 plus 8 is 34, sorry. This is 34, then 42, and then what, 50%. These are the payout ratios. You apply the payout ratio on the EPS, you get the DPS. So it's 10% of 56, 5.6 is 0.56, 10% of 7.84 is 0.784. So these are the forecasted dividend. Payout ratio applied on the earnings per share. Okay, is dividend per share. So very clean sum. Present value of the post-tax cost of capital is 17%. Okay. So the discount rate is 17% and the discounting factors are given. Whenever the discounting factors are given, you have to use them. Okay, so are you seeing the first dividend 0.56 will be multiplied by the first discounting factor 0.855 and we'll get the present value of dividend for the first year and so on till the 10th year. You are required to calculate the intrinsic value of the stock based on expected dividend. If the current market price of the stock is 125, suggest whether it's advisable to buy the stock or not. So you'll get the present value of dividend for the first 10 years, the table part, and then you know P10 is equal to D11 by RE minus G. P10, okay, P10 is equal to D11 by RE minus G. In the table you will already have D10, so it's D10 into 1.1 divided by 0.17 minus 0.1, and then present value of P10 will be P10 multiplied by the last discounting factor, which is 0.209. Okay, that will give us the present value of P10. So that's the horizon period. So you get the present value of the 10 years in the table, and you get the present value of P10, and that total is the answer for the intrinsic value of the share. Compare with 125 and state whether the share is underpriced or overpriced. Let's look at the solution. Perfect growth, EPS, payout ratio, DPS. These are the dividend per share, present value factor. So present value of dividend, and the last dividend was 28.71. That into 1.1 RE minus G into 0.209, the last factor, 94.29 plus 24.46. 118 should have been the intrinsic value, whereas the price is 125. The share is overpriced. Should not buy. Okay, should not buy. We have done much difficult sums in class where the discount rate also changes, the beta changes. Okay, and we do sequential discounting. Look at the copy for better sums. Okay, perfect. Question number 8 is one of my favorite questions, okay, on index futures beta management. In fact, it is such an old question that Institute nowadays solves it twice. Once by doing continuous compounding and once by doing normal compounding. So people can choose whichever solution they want. So you can see in the question, the index is 25,000, that is yes. Value of the portfolio VP is 50,50,000. This is we have to hedge. Risk-free rate is 9%, dividend yield is 6%, beta of the portfolio. Beta P is 1.5. We assume that a futures contract on the index with 4 months maturity is used to hedge the portfolio for 3 months. We want to hedge for 3 months, but the futures maturity is 4 months. But the pricing has to be based on 4 months. One futures contract is for delivery 50 times the index. That's the multiplier. Price of the contract. So price of the contract, if you find out by exponential, it will be F equal to S into E power R minus Y into T. So 25,000 into E power 0.09 minus 0.06 into 4 by 12. Or if you want to do simple, 25,000 plus 9% of 25,000 into 4 by 12 minus 6% of 25,000 into 4 by 12, whatever way you find out. So that is the end price of the contract they have said. So please multiply it by 50 at the end. Otherwise the answer won't match. The gain on short futures position, if index turns out to be 22,500 in 3 months. So we had a hedge for 3 months now. So after 3 months, the spot becomes 22,500. So first of all, how many contracts did we sell? So VP into beta T minus beta P divided by F into M. So VP is 50,50,000. We are perfectly hedging. So 0 is the target beta, 0 minus 1.5 divided by F into M, the futures price into multiple. So you find out the number of contracts to be shorted. Then after 3 months, you will square them off. So you require the new futures price. The spot is given 22,500 and 1 month left. So 22,500 plus 9% minus 6% of 22,500 into 1 by 12. Find out the new futures price. So you had the old futures price, the new futures price, the price has fallen. I think the price has fallen, yes. So in that case, you sold futures, so you gain on futures. What do you gain on futures? The old futures price minus the new futures price multiplied by, okay, the number of contracts, which is what, 50, the number of contracts into 50. Old futures price minus new futures price into 50 into number of contracts. That is profit on futures. That is profit on futures. Okay, so that's what they want. The gain or loss on futures, the gain on futures is that much. Do look at the solution, please.
Again, question number 5 is a two-party swap, currency swap. But this question we had not done in class as far as I remember. Okay, anyway, it's straightforward. Okay, just remember that whatever a person wants to borrow, he will not borrow that. He'll borrow the ulta. Okay, that's what happens in a swap. IB, an Indian firm, has its subsidiary in Japan. Zaki, a Japanese firm, has its subsidiary in India. Face the following rates. Rates are given. Zaki wishes to borrow rupee loan. So what's the cost of Zaki rupee loan? BPLR plus 2.5% underlined. While IB wishes to borrow JPY at a fixed rate. So IB, JPY 2%. So I've underlined 2%, I've underlined BPLR plus 2.5%. The remaining 2 I'll put a star. Okay? Perfect. The amount of loan required by both the firms is same at the current exchange rate. They have not even given the exchange rate. So even if you have a feeling towards currency, it'll go away. A financial institution may arrange a swap and requires 25 basis point as commission. Perfect. Gain, if any, is to be shared equally by both the firms. Whether a swap can be arranged by which may be beneficial for both the firms. Yes, because the 2 stars that you have given, like if IB borrows INR floating, BPLR plus 0.5 and Zaki borrows JPY fixed 2.25, the total cost will be BPLR plus 2.75. Whereas if they borrow their own, total cost is coming to BPLR plus 4.5. That means there is a scope of improving 1.75%, out of which 0.25% shall be enjoyed by the intermediate bank. So 1.5% shall be enjoyed by these two. That is 0.75% each. Okay, should I repeat? See, once again go to the table. Zaki wants to borrow INR floating. You have underlined BPLR plus 2.5. If you're not underlining, I can't explain to you. IB wants to borrow JPY fixed. So I'm underlining 2%. The remaining to use star. So we have star BPLR plus 0.5% and 2.25%. So effective cost without the swap is BPLR plus 2.5 plus 2, that is BPLR plus 4.5. Effective cost with the swap is BPLR plus 0.5 plus 2.25, which is BPLR plus 2.75. So the benefit of the swap is 1.75%, out of which 0.25% shall be enjoyed by the intermediate bank. So 1.5% shall remain for the two companies to be shared equally. So 0.75% each. So the effective cost for IB shall be, उसका underline क्या था? उसका underline was 2%. So 2% minus 0.75, which is 1.25% gain. 1.25% gain. And Zaki, what was the underline? BPLR plus 2.5 minus 0.75. So BPLR plus 1.75. BPLR plus 1.75 INR is the cost to Zaki, and for IB the cost is 1.25%. Okay, you may check the answer and please follow the presentation of the institute. So question number 5. This is a nice sum on calculation of NAV, slightly different as compared to the old sums of this type which we had done in class. If you look at the sum, basically we have to find out NAV. So we have this portfolio where there are 5 sectors in which investment in shares has been done. The investment amount is given: pharmaceutical, construction, service sector, IT and real estate. If I am logical, then I will take you down into the same sum and you will find that the sectoral index is given. Index on the purchase date, index on the valuation date. So accordingly we can apply unitary method. For example, if we go up in the pharmaceutical, we invested 79. Let's go down, and the index changed from 260 to 465. So 79 into 465 by 260, that's the value of the pharmaceutical. 79 into 465 by 260, that's coming to 141.288. That way you will value the construction, service sector, IT and real estate. Perfect. Let's go up. So if I go up, now we have invested in bonds, listed, unlisted. Okay, the listed bonds, they have a 14% coupon. They have a face value of 12 crores. If we look at the last line in the table, we are given the market expectation on listed bond is 8.842%. That's the YTM, and the maturity of the bonds is not given. So it is but logical to assume that they are perpetual bond. So the market value of a perpetual bond is A by I, where A is the coupon amount. So 14% of 12 crores divided by 0.08842. 14% of 12 crores divided by 0.08842. 14% of 12 crores divided by 0.08842, it's coming to 19 crores. It's A by I, 19 crores. And unlisted bond, the valuation is not given. So we take it to be 7 crores only. So we have valued the entire stocks. We have valued the listed bonds, 19 crore. Unlisted bond, we take it to be 7. We add all of them up. That's total asset. Expense payable item number 4 is given. Sorry, cash and cash equivalent is given. We add. That's total assets. Then expense payable we deduct. Correct? So total assets is the total portfolio plus cash and cash equivalent minus expense payable. When we do that, we get the net assets. I think that's the first question. The first question is NAV of the fund. So NAV of the fund is that only. Let's look at the solution. You can see in the solution, it's solved in the same manner. All the 5 sectors have been valued by unitary method. Listed bond 19 crores, unlisted bond 7 crore, add cash plus expense payable. So NAV is coming to 415.665 crores. That's the first part. Okay, and since we are in the solution only, you can see the second part, NAV per unit. So 415.665 divided by number of units, that comes to 98.97. So the first and the second part are over. For the third part, let's move into the question. So in the third part, it's saying if the period of consideration is 2 years and the fund has distributed rupees 3 per unit per year as cash dividend, that means in 2 years, 3 into 2, 6, ascertain the net return. So to calculate the net return, we would like to apply the formula dividend, that is 6 rupees, plus the change in NAV divided by beginning NAV into 100, correct? 6 plus the change in NAV by the beginning NAV into 100. Ending NAV we have already calculated in part 2. Okay, part 2 of the question. We have calculated the ending NAV. So for part 1, we need the beginning NAV. Let's go back to the table again of the question. Okay, so if we are looking at the table again of the question, so the beginning NAV is, we can just add up now, 79 plus 31 plus 56 plus 34 plus 10 plus 12 plus 7. So that was the amount invested at that time. Okay, that divided by number of units can be taken as the beginning NAV. Let's check the solution. So if you look at the solution, they have done the same. Investment in shares, investment in bonds, 229 divided by 4.2, 54.52. So 54.52 was the NAV. I'm looking at the solution, and 98.97 is the NAV. So change in NAV is 44.45. Dividend is 6. So we earned 50.45 by investing 54.52. Okay, we earned it in 2 years. So into 1 by 2 into 100. 50.45 by 54.52 into 1 by 2 into 100. That comes to 46.27%. Now the question is saying ascertain the expense ratio. Ascertain the expense ratio. So if you look at the question nicely, after the second table, it is given the fund has incurred the following expenses: 480 lakhs, 150 lakhs, 38 lakhs. So expense ratio is basically the expenses divided by the average assets under management. Average assets under management. Now, surprisingly, ICAI has not printed the answer itself. God knows what they're doing. So what we can do is that the total expense, we can add a 480 plus 150 plus 38. That's coming to 668. Now we have to divide by the average assets. The best thing is that the average asset is the opening and the closing divided by 2. I'm not talking about the NAV per unit. I'm talking about the net asset value. Okay, we calculated the closing in the first part, NAV of the fund, and we calculated the opening when we did the third part. Okay, that time we calculated the cost. Now, I'm not talking about the cost per unit, I'm talking about the total cost. So the initial plus the ending divided by 2 is the average assets under management. So expenses divided by the average assets management into 100. That should be the answer, but then it's 2 years. So maybe you have to do into half. Why do I say maybe? Because ICA is not given the solution. So what do I do? So this is question number 12. The second question on TR, SR and UR of a portfolio. And this has no ambiguity. Okay. In this question, we are given 3 stocks, D, E and F. Please look at the table. The weights are given, the beta is given. So the first thing is that you can do weighted average and you calculate beta of the portfolio. Return is given. If you want the return, you can calculate weighted average. You can get the expected return of the portfolio. Variance is given. You can't do weighted average, okay? Because we don't have a formula called weighted average variance. Now, below the table, SD of the market is given 10%. So what would that be used for? In case we require systematic risk. So beta square variance of market, we'll get the systematic risk in case we require, okay? You are given the following data. Covariance of D with E. Covariance of D with F, covariance of E with F. Now this is the Markowitz covariance. Okay, because do you remember? The covariance according to CAPM is beta A into beta B into variance of market. If some of you remember, CAPM believes that we don't find out the covariance of any pair of stocks. We believe that all stocks are correlated to each other because of market. So for instance, if I were to calculate the covariance of D and E, covariance of D and E as per CAPM, it would be beta of D, which is 0.4, into beta of E, which is 0.5, into variance of market, which is 10 square 100. So 0.4 into 0.5 into 100. That would come to 20. Okay, of course, when I say 20, it is 20 square. That means percentage square. Whereas the 0.03 which is given over here is 0.03 into 100 square. 0.03 into 100 square, which is what, 300. Okay, that's the covariance which is given over here. Okay, so you have to be very careful about this thing. The total variance also, which is given in the last column, is supposed to be multiplied by 100 square to get it into percentage square. So that 0.015 is actually 0.015 into 10,000, which is what, 150. 0.025 is what, 250. Okay, and 0.1 is actually what, 1,000. So that's 150, 250 and 1,000. Okay, so you got to multiply variances with 10,000 to get percentage square. Be careful about that. Anyways, I have not yet read the question. The question is calculate the portfolio variance considering correlation between each pair, that means the Markowitz approach, and co-movement between securities due to change in the market index. Now that's the Sharpe index approach. Do you remember there was an earlier question where they had mentioned calculate the portfolio variance as per Markowitz and as per what? Sharpe. So in Markowitz we use the covariances that are given. In Sharpe we don't use the covariances. We can calculate covariance by beta A into beta B into variance of market. So now what I would like to tell you is the easiest way of solving the sum. If you just look at this question, do not look at the solution, just keep the question open. Okay, is that we apply that variance of portfolio formula, which is weight square into variance plus weight square into variance plus weight square into variance, okay, plus 2 into WD WE into COV DE plus 2 into WE WF into COV EF plus 2 into WD WF into COV DF. Understood? That way. But where I am afraid is that when you apply this formula, either take everything in decimal or take everything in what? Percentage square. I think over here everything is given in decimal, so don't spoil it. Take everything in decimal. So for example, my figures would be 0.2 square into 0.015 plus 0.5 square into 0.025. I hope you are looking at the question. I am looking at the question, not the answer. 0.2 square into 0.015 plus 0.5 square into 0.025 plus 0.3 square into 0.1. Correct? Now plus 2 into 0.2 into 0.5. That means weight of D into weight of E into 0.03, the covariance. Then let's come to D and F. 2 into 0.2 into 0.3 into 0.02 D and F. Now 2 into 0.5 into 0.3, that is E and F, into 0.04. Okay, that's how they have done. Let's check. Okay, let's check the solution. The first part is very, very simple. If somebody cannot do calculation, then what do I say? So this is what I was saying. Weight square into variance, weight square into variance, weight into covariance. Okay, and so on that they have done. You have to compute. Let's hope that the answer is matching. 0.0363. 0.0363. Okay, I don't know. Okay, yes, it's matching. The student sitting beside me is saying that yes, sir, it's matching. 0.0363 is the correct answer. No need to take a square root. They're asking you to calculate portfolio variance. Now, let's go back to the question. If we go back to the question, second part, we have to use co-movement between the securities due to change in market index. Now, they have done this solution by a particular method, which is correct. But I think it could have been solved easier. How? You calculate new covariance between D and E. What would that be? Look at the data. It would be 0.4 into 0.5 into 100. Okay, beta D into beta E into 10 square. That comes to 20, but take 20 as a decimal, better. So 20 by 10,000. 20 divided by 10,000, what is it? 0.002. So you take the covariance DE to be 0.002. Now let's go to DF. 0.4 into 1.1 into 100. 0.4 into 1.1 into 100. That comes to what? 44 divided by 10,000. 0.0044. 0.0044. And the third one, E and F would be 0.5 into 1.1 into 100. 0.5 into 1.1 into 100. And this comes to 55. That is 55 by 100. 0.0055. Okay, so these are the covariances, and you can once again use the formula, but they have done it in what manner? They have illogically computed. Okay, let me not show the answer, let me concentrate on the question only. I'm in the question only. They have calculated the systematic risk for D, which is beta square into variance of market, systematic risk for E, systematic risk for F, and then unsystematic risk is total risk minus systematic risk. They calculated for DEF. Then they calculate systematic risk for the portfolio as beta square into variance of market for the portfolio. Then they computed unsystematic risk for the portfolio. I think it could have been better done by the same method as part 1, but just calculate the new covariances. Please try the same and match the answers. Okay. Of course, if the answer doesn't match, I don't think that would be an eventuality. If it doesn't match, you have to follow the institute. Okay. So risk management question number 4. Now this question is actually not on war. This question is on the concept of normal distribution, and that is why everybody should know normal distribution. So we know that normal distribution is a bell-shaped distribution with 2 parameters, mean and SD. Mean in this sum is 2 crores, standard deviation is 1.6 crores. You should draw the normal distribution. There are 2 scales, X scale, Z scale. So X is NPV over here and Z scale is the standard normal distribution. So mean in the center is 2 crores. Now, the sum says that in case the company loses more than 1 crore, there will be financial difficulties. So determine the probability of financial difficulty. So loses more than 1 crore. So that means the loss minus 1 crore has to be marked on the left side. You have marked 2 crore at the center of the distribution. You should mark minus 1 crore on the left side. Okay, on the left side. When you mark minus 1 crore on the left side, okay, you have to shade the left tail. And when you do that, calculate the Z corresponding to minus 1. What is the formula for Z? Z equal to X minus mu by sigma. Z equal to X minus mu divided by sigma. So you get minus 1 minus 2 divided by 1.6. Minus 1 minus 2 divided by 1.6, that comes to minus 1.875. So I mark minus 1.875 in the graph. Okay, minus 1.875 in the graph. Please have a look at the graph. Now I have to find out the probability of Z less than minus 1.875. So I go back to the question, and in the question I have 1.87 probability, 1.88 probability. So 1.875 is obviously 0.4693 plus 0.4699 by 2. 0.4693 plus 0.4699 by 2. That comes to 0.4696. 0.4696. Now this is the area between 0 and Z, between the mean and that figure, 0 and Z. But we want to find out the area in the left tail. So 0.5 is the area on both the sides. So 0.5 minus 0.4696. 0.5 minus 0.4696. Okay, so 50% minus 46.96%. That means 3.04% is the answer. 3.04%. Institute has done it wrong. They have given the answer 46.96%. That is wrong. 3.04% is the answer. Okay, this time you are supposed to give the correct answer because they will acknowledge the mistake. Thank you. So here we have question number 1. Given the following information, okay, day limited and night limited. If you look at the table, earnings are given, PAT, and number of shares given. It is also mentioned that day limited has a P ratio of 20 times, while night limited has a P ratio of 15 times. So from the table, one can find out the EPS, that is 5 crores by 10 lakhs. And 3.5 crores by 7 lakh, and if you multiply the EPS by the P ratio, you'll get the share price. So what I would have done is that I would have prepared a table in which PAT 5 crore, 3.5 crore, number of shares 10 lakh, 7 lakh, EPS 5 crore by 10 lakh, whatever, 3.5 crore by 7 lakh, whatever, P ratio 20 times, 15 times, share price this much, this much. Okay, value of firm A, number of shares into share price, value of firm B, number of shares into share price. So this table I would have completed. So you can also do it at your end, because I'm going to explain it logically, but not by calculations. Okay, please understand. There's nothing great in the sum. Day limited considers takeover of night limited. So day limited is the acquiring firm, night limited is the target firm. By paying 55 crores, considering that the market price of night limited reflects its true value. So we are paying 55 crores to night limited. That is the purchase consideration. Now whether we are paying that 55 crores in cash or stock, that remains to be seen. It is considering the following options. First option, stock deal. First option, cash deal. Second option, stock deal. You are required to calculate the cost of the takeover. Cost of the takeover means the true cost. That means the amount that we are paying to night limited over and above its own value. It's like NPV to A.
So what is the NPV to A? The extra that A, the NPV to B. That is the extra that we are paying to B. Okay, true cost to A is equal to NPV to B. We also did it in question number 6 in the first class. So true cost of acquisition to A is the NPV to B. That is the extra that you are paying tonight. Okay, and advised day limited on the best alternative. So obviously the best alternative shall be the one in which the cost of acquisition is the lowest. So you'll have to calculate true cost twice. Alternative 1, alternative 2. If we look at alternative 1, so 55 crore is what we are paying. And what is the market value of Knight Limited? You must have already calculated in the table. I think it is coming to 52.5 crore. Let us look at the institute solution. Yeah, the market value of Knight Limited is 52.5 crores and you are paying 55 crores. So what is the cost of acquisition? 55 minus 52.5, 2.5 crore. But if we are issuing shares, then the point is how many shares are we issuing? So we have to pay the other party 55 crores and our share is worth what? 1000. Look at Day Limited share price, 1000. So 55 by 1000, we are issuing 5,50,000 shares. Okay, 5,50,000 shares. That 55 crore by 1000, that number of shares we are issuing. So if we are issuing that number of shares, okay, so in that case, the point is what is the true cost of acquisition? For this, we need the combined value, okay, so that we can find out the post-merger value that Knight Limited is getting. So since synergy is not given in the sum, combined value is VA plus VB. Now somebody will argue that, sir, sometimes while finding out the combined value, you do profit of A plus profit of B and you combine by the P ratio and speak of bootstrap, and sometimes you do VA plus VB. Actually, if you have practiced a lot of sums, you will find that we do VA plus VB when the P ratio stuff is not given in the sum, as in that is not very important, that's not highlighted in the sum, post-merger EPS and all that is not required in the sum, then we understand they are doing it as VA plus VB. When the post-merger EPS and all that is highlighted in the sum, then it's EPS into P ratio. So anyways, so the value of A is around 100 crores and value of combined value 152.5 crores. And what is the ownership of Knight Limited? The ownership of Knight Limited will be the number of shares issued to Knight Limited, which is 5.5 lakhs divided by 10 lakhs plus 5.5 lakhs, the combined number of shares. That comes to 35.48% ownership position. If you want to look at the formula, okay, I know most of you don't like formulas, but some people may wish to have formulas. The ownership position of B is always RNB divided by NA plus RNB. Okay. Now you don't have to take RNB as a formula. This is the number of shares issued to B. So here we were paying 55 crores to B in the form of our shares worth 1000. So we issued 5,50,000 shares to B. So this is 5.5 lakhs. Okay, this is 5.5 lakhs and this is what? 10 lakhs. So we got the ownership position 35.48%. So whatever is the combined value, B is getting 35.48% of that. So accordingly, the true cost to A will be ownership position of B in the combined firm into VAB minus VB. So we already computed VAB as VA plus VB. Ownership position 35.48 and VB is 52.5 crores. Let's see what they've calculated. So they've calculated negative minus 0.893. Now that's lottery. If A can have a negative cost of acquisition, what more does it require? So in part A, the cost of acquisition is 2.5 crore. In part B, the cost of acquisition is negative 0.893 crores. So obviously, from the point of view of the acquiring firm, negative is good. The cost of acquisition negative. So we would prefer the stock deal. Okay, that's the question. Let's move to the next question now.